Welcome back to The Explainer. Today, we're diving headfirst into the absolute extremes of equity investing. We're talking about the small cap universe. You know, that space where massive, life-changing wealth creation totally collides with heart-stopping market swings. If you've ever wondered how to actually navigate this high-risk, high-reward territory without completely losing your shirt, you are absolutely in the right place. We're going to use a fascinating case study today, the Invesco India Small Cap Fund. We'll unpack exactly how elite fund managers balance explosive growth with structural, sleep-at-night safety.
Okay, let's dive into this. Here's our roadmap for today. Section 1 is decoding small-cap mutual funds. Then Section 2 on Invesco India's historical performance. Section 3 covers measuring volatility and risk. Section 4 is peer and benchmark comparisons. Then we'll get into insights for conservative investors in Section 5 and wrap it all up with Section 6, the Invesco Advantage.
All right, Section 1, decoding small-cap mutual funds.
So, before we get into the weeds, let's break down the ground rules in plain English. SEBI basically mandates that if a fund wants to call itself a small-cap fund, it absolutely has to invest at least 65% of its money into companies ranked 251st and beyond on the stock exchange. Now, why the 251st company? Well, the top 100 are your giant large caps, right? The next 150 are your established mid caps. So by deliberately targeting the 251st company and below, you're explicitly hunting for younger, aggressive, high-growth businesses. These are the companies that just haven't peaked yet.
But listen, this hunt comes with some serious built-in tension. As our sources beautifully put it, small caps occupy the highest risk and highest potential return band of the entire equity universe. We're talking about a space where a company can literally multiply its size 20 times over. But, and this is a massive but, it's also a space that has historically seen drawdowns exceeding 50% during bear markets. It is the ultimate double-edged sword. Moving right along to Section 2, Invesco India Historical Performance. Now, what's really interesting about our central case study today, the Invesco India Small Cap Fund, is its track record since launching in October 2018. They're currently managing over 13,000 crores in assets, and the sheer power of compounding we're seeing here is incredible. Just look at the journey of this capital. Over a one-year trailing period, the fund delivered 13.52%. Over 3 years, it averaged an explosive 25.02% annually. And over a 5-year horizon, it compounded at 21.13%. If you just visualize your capital growing at over 20% year over year for half a decade, it becomes crystal clear why investors flock to this specific category.
But hey, any fund can look like a genius if you cherry-pick a specific start and end date, right? That's exactly why professional analysts focus on rolling returns. The Invesco fund boasts a 3-year average rolling return of 28.01%. This is a huge takeaway for us. Rolling returns measure performance across all possible entry points. It pretty much proves that the fund's bottom-up strategy, picking fundamentally strong companies one by one, actually works consistently, regardless of whether the broader market is in a boom or totally slumping.
Which brings us to Section 3, measuring volatility and risk. Because, let's be real, high returns are really only half the story. The ultimate stress test is how a fund behaves when the floor drops out. In the past year, Invesco experienced a maximum drawdown of 15.11%, and it took 105 days to recover to its previous peak. Think about that for a second. That means for about 3.5 months, your portfolio was sitting underwater. This is the harsh reality of small cap investing. You've got to have the psychological discipline to just sit on your hands and do absolutely nothing while the fund recovers. To truly get a handle on that risk, we need to contrast two critical metrics, alpha and beta. You can think of alpha as the fund manager's magic touch. It's the excess return they generate above what the market naturally gives you. Beta, on the other hand, measures the wildness of the ride. A beta of 1.0 means the fund moves exactly in tandem with the broader market.
And that brings us to a frankly incredible number, 6.83. That is Invesco's specific alpha. It visually anchors a massive point for us today. The fund managers, Tahir Badshah and Adichie Kumani, are successfully generating almost 7% in excess returns purely through their active stock picking skills. They are consistently beating the benchmark for the exact level of risk they're taking on.
So the crucial point is how they achieve that alpha. Take a look at the beta. It sits at 0.82. Because it's well under 1.0, it means the fund is actually about 18% less volatile than the broader small cap market. When you pair that with a standard deviation of 16.93%, which is just a fancy way of measuring how wildly those returns fluctuate, it tells us the managers are actively smoothing out some of the market's wildest swings. They're giving investors a slightly calmer ride without sacrificing those top-tier returns.
All right, Section 4, Peer and Benchmark Comparisons.
Of course, none of these numbers exist in a vacuum, so we have to stack them up. Notice the yawning gap here between the Invesco fund and its benchmark, the BSC 250 Small Cap Total Return Index. Over 1 year, the benchmark did a pretty meager 2.98%, while Invesco cleared 13.52%. Over 3 years, the benchmark is sitting at 18.86%, while Invesco smashed past 25%. This right here proves that paying the expense ratio for active management in this specific fund is actually yielding tangible, benchmark-beating results.
And this brilliantly illustrates how Invesco holds its ground against actual human competitors, not just an index. Looking at the 3-year compound annual growth rate, you've got an aggressive challenger like Bandon slightly edging it out, sure, but Invesco significantly outperforms massive heavyweights like Nippon and HDFC over both the 1-year and 3-year periods. It really just sits squarely in that sweet spot of high growth and resilient momentum.
Next up, Section 5, Insights for Conservative Investors.
So, you might be sitting there wondering, okay, this is a ton of dense data. If I'm a beginner or just a more conservative investor, how do I actually bridge the gap between heavy statistics like alpha and beta and a practical sleep-at-night wealth-building strategy? Well, the secret lies under the hood, and how this fund is physically built.
Check out this specific asset allocation. Remember that SEBI rule we talked about requiring 65% in small caps? Well, Invesco sits right at 68%. But here's the clever part. They strategically deploy 16.8% into mid-caps and almost 14% into stable, giant, large-cap stocks. They're using that remaining discretionary allowance to essentially build a shock absorber right into the portfolio. And that is exactly where that low beta of 0.82 comes from. That specific allocation creates what the industry calls a liquidity buffer. Our sources highlight this as a massive, massive insight for conservative investors. Recent SEBI stress tests actually reveal that Invesco can liquidate 50% of its total portfolio in just 7 days. Now, because small-cap stocks can be notoriously hard to sell when the market panics, having a portfolio liquid enough to cash out half its value in a single week provides incredible structural downside protection. It means the manager won't be forced into a fire sale of good companies just to meet redemption requests.
Finally, Section 6, the Invesco Advantage.
Let's synthesize everything we've uncovered today into the core strengths of this fund. If you're taking notes, these are your final takeaways. The Invesco Advantage is really a balanced path forward. It gives you structural downside protection through those clever large and mid-cap buffers. It delivers consistently positive alpha and rolling returns that totally justify the active management fee. And it gives you lower volatility than pure market swings. But, and please remember this, the data strictly suggests this is a vehicle for a 7 to 10-year horizon, ideally utilizing a SIP, a systematic investment plan, to average out your costs during those inevitable market dips. Because ultimately, small-cap funds are the high-octane growth engines of a diversified portfolio. They are not the entire vehicle. The data proves the wealth creation potential is very real, but the structural risks are equally present. So I'll leave you with this thought to reflect on. Does your portfolio, and honestly, your mindset, have the discipline to stomach short-term volatility in exchange for massive, long-term wealth creation? Thank you so much for joining me for this explainer. Until next time, keep learning, keep analyzing, and stay focused.